Happy Thursday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. And first up, in a report published this week, analysts at Bank of America Securities argue that China's stock market may be headed for a, quote, significant correction, end quote, drawing parallels between the current surge and the boom and bust cycle of 2015, which saw a catastrophic collapse in stock prices, one from which the stock market still has not recovered. The Hang Seng China Enterprises Index and MSCI China Index have soared over 30% from their January lows, reflecting the rapid gains of a decade ago before markets crashed. In 2015, the Hang Seng China Enterprises Index peaked in May, only to plunge nearly 50% in the following months, never fully recovering from those highs. Bank of America strategists, led by Winnie Wu, wrote in their note, quote, "There are quite some fundamental similarities between the current cycle and 10 years ago, with the economic rebalancing cycle and the policy cycle," end quote. They cautioned that the rally, largely driven by multiple expansions rather than fundamental growth, remains very vulnerable. The warning comes amid widespread optimism in Chinese markets, fueled by DeepSeek's AI breakthroughs and Beijing's pro-growth policies. A growing skepticism towards US economic dominance has also drawn global investors toward Chinese equities. However, concerns remain. Investors in Shanghai have expressed unease over weak job growth, deflation risks, and sluggish credit demand, according to Bank of America's investor discussions. Some also fear the emergence of bubbles in select tech sectors. Despite these risks, Chinese stocks have continued their strong performance. The Hang Seng China Enterprises Index dipped 0.9% on Wednesday before recovering, while the MSCI China Index remains up over 23% year to date. Wu and her team previously noted that the worst of China's stock devaluation was likely over. Whether the rally sustains or follows the 2015 trajectory remains to be seen. We will continue following the space closely. Next up, we move from the economy to geopolitics and diplomacy. The G7 foreign ministers meeting in the US this week produced one of the toughest joint statements on China to date, signaling a shift in tone among the bloc's major powers. While internal divisions remain, particularly between the US and European members on trade policy, the statement demonstrated a firm stance on Beijing's military and economic activities. The G7 condemned China's alleged role in enabling Russia's war in Ukraine, citing its provision of dual-use components as a decisive enabler of Moscow's military efforts. The ministers reaffirmed their commitment to a, quote, free, open, prosperous, and secure Indo-Pacific, end quote, expressing serious concerns over China's military buildup, particularly in the East and South China Seas. The statement specifically condemned the increasing use of, quote, dangerous maneuvers and water cannons, end quote, against Philippines and Vietnamese vessels, and called for the peaceful resolution of cross-strait issues, here referring to Taiwan, emphasizing opposition to any unilateral changes to the Taiwan status quo by force or coercion. A notable shift in the statement was its omission of previous G7 assurances that there is, quote, no change in the basic position, end quote, on Taiwan, including recognition of the One China policy. Additionally, past statements mentioned a desire for, quote, constructive and stable relations with China, end quote, were also removed, further reflecting a hardening stance. The G7 also raised concerns over China's expanding nuclear arsenal, urging Beijing to engage in strategic risk reduction talks. Economic issues were also at the forefront, with the bloc criticizing China's non-market policies and calling on Beijing to avoid export control measures that could disrupt global supply chains. Beijing swiftly condemned the G7 statement, with Foreign Ministry spokesperson Mao Ning dismissing the allegations as, quote, a deliberate mischaracterization of the facts, end quote. China denounced the G7 for interfering in its internal affairs, stating that Taiwan remains, quote, at the core of China's core interests, end quote. Mao accused the G7 of sowing discord and, quote, provoking disputes, end quote, in the South China Sea, while turning a blind eye to US nuclear proliferation concerns through AUKUS. On the economic front, China rejected claims of harmful overcapacity and market distortions, asserting that the G7 is, quote, politicizing and weaponizing trade and economic ties, end quote. Beijing also dismissed allegations of providing military support to Russia. The tougher G7 statement marks a potential turning point in Western engagement with China. However, as the saying goes, talk is cheap. Nevertheless, as global power dynamics continue to shift, the G7's evolving position on China signals a more confrontational approach, one that Beijing is unlikely to accept quietly. With both sides doubling down on their respective narratives, The geopolitical fault lines between China and the West appear to be deepening. And speaking of geopolitical tensions, in a piece published yesterday, US-based Bloomberg, citing unnamed sources, reports that Beijing is holding back approval for BYD's proposed manufacturing plant in Mexico, citing concerns over potential leaks of advanced smart car technology to the United States. The move underscores China's cautious approach amid rising trade tensions and shifting geopolitical dynamics. It is, of course, worth noting that one of China's industrial policy strategies over the last 2 decades has been to force Western and Japanese car makers to produce or manufacture their cars with a joint venture partner in China itself, as a way of accelerating technology transfer to China from Europe, North America, and Japan. So Beijing, more than anyone, would be aware of the risks of the reverse happening with their new EV technology. BYD, China's largest electric vehicle maker, had initially announced its plans in 2023, aiming to create 10,000 jobs and produce 150,000 cars annually. However, Chinese automakers require approval from the country's Commerce Ministry to manufacture overseas, and BYD's request remains pending. Officials worry Mexico's proximity to the United States could allow Washington access to BYD's technological advancements. This week, BYD announced that it had produced an EV that can be charged in just 5 minutes, causing its stock value to jump. We covered this at the time. Mexico's government has also called on the investment amid trade frictions with the United States. President Donald Trump has accused Mexico as serving as a, quote, back door, end quote, for Chinese goods, prompting Mexico to impose tariffs on Chinese textiles and investigate steel and aluminium imports. While BYD remains committed to expanding in Mexico, company executives, including Vice President Stella Lee, acknowledged ongoing uncertainties. Meanwhile, BYD faces setbacks elsewhere, including a stalled $1 billion project in Brazil due to a serious scandal around labor violations. Despite these challenges, BYD sold over 40,000 vehicles in Mexico last year and aims to double sales in 2025, signaling its long-term commitment to the market. As many of you know, this week I launched my second channel, Market Update. This new channel uses the China Update approach to grounded and sober analysis to explore the biggest, most up-to-date economic and financial updates in North America, Europe, and Asia. A new video just went up about an hour ago. I'm particularly excited about this new video. This is perhaps my favorite to date. I've included a link in the first line of the description. Some people have difficulty finding this. In the first line of the description below the video, you'll see a link. It has a YouTube icon next to it. I've also put a link to this new video in the comments below. Thank you everyone for all the support for both China Update and Market Update. I hope you enjoyed today's video as much as I enjoyed making it. And if you're liking this episode of China Update, don't forget to like, and if you haven't already, subscribing is a big help. Thank you so much. And finally for today, Chinese banks are slashing consumer loan interest rates to historic lows in a bid to stimulate domestic spending and counter the economic impact of US tariffs. In major cities such as Shanghai and Hangzhou, banks are engaged in fierce competition, offering annual interest rates as low as 2.58%, a sharp decline from the 10% rate seen just 2 years ago. The move aligns with Beijing's broader strategy to fuel consumer demand and reduce the economy's dependence on exports. The National Financial Regulatory Administration recently urged lenders to expand consumer loan issuance while ensuring reasonable credit terms. However, despite the availability of cheap loans, weak income growth expectations and economic uncertainty continue to weigh on consumer sentiment. Analysts caution that while lower borrowing costs may encourage spending, banks face risks as they struggle with declining profit margins and increased exposure to potentially weaker borrowers. The impact of these measures remain uncertain. Peking University Professor of Finance Michael Pettis observed on this development today, quote, Chinese regulators have put pressure on banks to increase consumer lending. If they succeed, this is certainly one way to reduce the excessively high household savings rates that is part of China's weak consumption story. Household borrowing, after all, is a kind of negative saving, and either reducing household saving or increasing household loans is a way to increase the consumption share of GDP without undertaking the more difficult task of increasing the household income share of GDP. But while this may help boost consumption in the short term, it mostly does so by moving future consumption forward. This isn't necessarily a zero-sum process, however. If more consumption today leads to more high-quality growth, and it almost certainly will, which in turn pushes the economy into a self-reinforcing process of stronger growth leading to higher incomes. But if it doesn't, more consumption today will be balanced by less consumption tomorrow as households pay down their debt. There are two potential problems with the program. First, Chinese banks are already suffering from record low net interest margins, which a price war to expand consumer lending won't help. And second, competition to expand consumer loans generally means that banks will take on lower quality credit. Nearly every time that regulators have demanded that Chinese banks expand consumer lending, there has been a deterioration in credit quality. Still, if banks do what they are told and aggressively expand consumer lending, this may be among the most effective policies so far to boost the consumption share of GDP. The longer-term impact will be hard to judge, but the short-term impact will be positive. End quote. Okay, that is today's episode of China Update. Thank you everybody for watching. Have a good Thursday. I hope I will see some of you over on Market Update for today's new Market Update video as well. Have a great Thursday, and I will see you all tomorrow.